very much what the People's Bank of China has been doing, and it's being emulated by Chinese nationals, Chinese citizens, who not only take delivery of gold and bars out of the Shanghai Gold Exchange system, but they also run gold accounts at their banks. And with the People's Bank of China having reduced interest rates a little bit recently, the alternative attraction, which is bank deposits, the Chinese housewife will take out a 3-year deposit in order to maximize the interest return. That's all coming down. So, of course, on a relative basis, it makes gold a lot more attractive. And bear in mind also that any Chinese national trying to hedge out of his currency can only do it in gold, because he can't go and buy dollars, buy euros, buy Canadian dollars, whatever. Can't do that.
In today's episode, we delve into the East's aggressive gold accumulation and the West's diminishing reserves with insights from financial expert Alasdair Macleod. The flow of gold from Western vaults, including the New York Fed, to countries like China, India, and Russia is accelerating as these nations prioritize gold as a hedge against Western economic instability. In stark contrast, the West continues to downplay gold's importance, a decision Alasdair warns could have serious consequences for global financial dominance. Concerns over missing gold in Western reserves add to the drama. Alasdair highlights Germany's struggles to repatriate its gold from the New York Fed as evidence of mistrust. Meanwhile, record-breaking physical deliveries from COMEX vaults point to mounting pressure on the West's ability to maintain liquidity in precious metals markets. These extraordinary flows, according to Alasdair, may signal the early stages of a crisis. China's strategic approach stands out, with Alasdair estimating their gold holdings may have quietly surpassed 20,000 tons by the early 2000s. In addition, Chinese citizens, encouraged by government policies, have accumulated another 26,000 tons. This systematic acquisition reflects not only the state's vision, but also a cultural understanding of gold as the ultimate store of value, something the West has seemingly forgotten. As the West deepens its reliance on fiat currencies, the East's focus on tangible wealth is reshaping the balance of global economic power. Alasdair's sobering analysis suggests that gold's role as real money may soon challenge the very foundations of the Western financial system. Now, we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and check the pinned comment, because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you safeguard your online activity and protect yourself from prying eyes. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
Now, again, this is where market commentators get the relationship between gold and yields completely wrong. They think that if you get a higher yield, it makes gold less attractive because gold yields 0 or 1% or on a lease rate or whatever. But what they ignore is the whole purpose of gold is actually to hedge out of credit. And what we're looking at in terms of credit is fiat currencies, and particularly in this case, the dollar. So if the value of the dollar starts going down in terms of its purchasing power, then gold will appear to rise. And that's basically what we face. I think that there's a huge error, if you like, in central bank thinking that the purpose of interest rates is to manage economic outcomes. No, it is not. I mean, if you go back to the days of gold standards, it was there basically to manage your gold reserves. In other words, if the gold reserves started going out of the door, you had to raise interest rates to make your currency, which was a gold substitute, attractive to the arbitrageurs to get the gold flowing back into your reserves. That's actually the true role of interest rates, is to stabilize the currency, not to manage the economy. And of course, so All central banks are doing completely the wrong thing. This is now basically what's happened is that by using interest rates to try and manage economic outcomes, every time there's been a credit bubble, the response from central banks has been to reduce interest rates sharply, to take the pressure off malinvestments, off the zombies, if you like, off banks which may be over leveraged for those conditions and face substantial loan problems, if you like, bad debts. Take pressure off markets. I mean, ever since Greenspan, he was talking about you've got to keep the stock market bubbling, take the pressure off the stock market. So you've had bubble after bubble after bubble, and we are now finally in the largest bubble ever known in history. This is larger than John Law. It is larger than South Sea bubble. This is the big one. It is larger than the dot-com bubble. And I remember the human psychology in the dot-com bubble was exactly the same as, you read accounts of, the Mississippi bubble and the South Sea bubble and the tulip mania and all these bubbles. I mean, it was up there with the extremes. This is twice as big. I mean, when this bursts, it is there's nothing, absolutely nothing any central bank can do about it. Because by reducing interest rates this time, they just collapse their currencies. That is really how serious this situation is. And I think that we're likely to see this develop in 2025. The only way out of it is just get the hell out of credit. And if you're going to get the hell out of credit, what do you go to? Well, the only thing is real money, which is gold, and to a lesser extent, silver.
In today's news recap, gold prices to tread water in final trading week of 2024. Low holiday trading volume in the final week of 2024 is expected to keep gold prices contained within their narrow range, according to some market analysts. Markets will be closed mid-week on January. So many analysts remain focused on celebrating the new year rather than monitoring financial markets. Barring any major surprises on the horizon, many analysts predict that gold prices will remain caught in a tug of war between rising bond yields and safe haven demand driven by increasing geopolitical and economic uncertainty. This past week, gold prices were capped at $2,650 an ounce. However, the market was able to withstand significant headwinds as the yield on 10-year Treasury notes rallied to 4.64%, its highest level in 7 months. The precious metal remains range-bound heading into the weekend, even as bond yields stay elevated above 4.6%. Spot gold futures last traded at $2,618.30 an ounce, down 0.57% on the day. Meanwhile, gold prices are down 0.18% for the week. Gold's resilience this week has been underpinned by escalating geopolitical tensions. Investors are closely monitoring conflicts in Eastern Europe and the Middle East, said James Hirchik, market analyst at FX Empire, in a note Friday. Israeli strikes against Houthi targets in Yemen and Russian drone attacks in Ukraine have reinforced gold's appeal as a safe haven asset. This geopolitical backdrop continues to keep gold in play, with traders hedging against the risk of further flare-ups. At the same time, some analysts note that social media comments from President-elect Donald Trump expressing an interest in annexing Canada, the Panama Canal, and Greenland have also heightened geopolitical uncertainty and tensions. Gold's short-term outlook remains bearish, with rising yields and dollar strength acting as stronger drivers than geopolitical risks, he said. However, the current move is unfolding during a historically slow trading week and thinner volumes may limit follow through. Now we'll show you the best clips of the latest interview, but first hit the like button, smash the subscribe button, and check the pinned comment because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you safeguard your online activity and protect yourself from prying eyes. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
Before we came on air. And as of yesterday, since Thanksgiving, it's 69 tons of gold and 1,324 tons of silver. Now, obviously, we don't know for certain who is standing for delivery. It strikes me that there must be many parties involved. So who could it be? I mean, you can see that in America, the people who are bullish for gold are really in a very tiny minority. The other thing is that if you look at the exchange for physical numbers, they are actually very, very high, particularly in gold. Now, what that tells us is that it's effectively it's an arbitrage between COMEX futures and London forwards. The exchange for physical basically is you go out of COMEX. What you do is you go out of COMEX and you go into a forward in order to take delivery. Now, you don't necessarily take delivery, and it could be the other way. So we have no idea as to exactly what the position is in the exchange for physical. But when you get high numbers, you know there is something going on in those markets. And just to remind you, when we had the run up, I think it was 2020, late 2020, when gold first ran up to challenge new highs, 2070, something like that. There was a crisis in the exchange for physical. And, deliveries couldn't take place between markets because of COVID and all the rest of it. And I seem to recall that HSBC said that on the exchange for physical, they lost over $200 million just on that. So this is actually a very, very serious business. The point about COMEX is that it was never meant to be a delivery market. I mean, the concept of a future is that at expiry, you have the option, if you like, to either sell your future, in which case the position closes out because for every long there's a short. Okay, so it closes out. Or alternatively, you can take delivery. But because it's a very highly leveraged market, the players in futures almost never take delivery. So why is everyone taking delivery now? Well, not everyone, but I mean, you can see that there are huge, huge quantities standing for delivery. And I think a lot of it is there is such demand for gold, particularly from Asia. We can talk about that a little bit, what's driving that. But there is such heavy demand for gold that they're even going in to try and sort of get the loose holders out of futures. So it's a bid-only market in effect for physical, and the only way you can get physical, go along to a refiner and say, when can you let us have some gold? They say back of the queue. If you go to start dealing in the forward market in London, then you might be able to get some. But the amount of liquidity in the vaulting system, in the LBMA's vaulting system, I guess is extremely low. I mean, it shows that they've got, however many thousand tons, but, in practice, very little of that is really available, if you like, to satisfy market deliveries. And we've got the same situation in COMEX. Again, you've got quantities there which are basically not really available for delivery. I mean, some of them may be registered for delivery, some of them may be eligible for delivery, all that sort of stuff. But, the reality is that the liquidity in these markets, in Western markets, is drying up because of demand from Asia. And it's running into that brick wall. And I think this is why, you've got these enormous quantities. I mean, 69 tons of gold is not a trifling amount. I mean, this is very, very serious stuff. This is more than most countries' gold reserves, you know, since stood for delivery on the December contract, on the expiry of the December contract. And also, it seems in its dying days, you see people going out and buying the December contracts so they can take delivery. I mean, this is, honestly, Jesse, this is an extraordinary, extraordinary situation. And I think it does tell us that there are strains in the market. Now, we can't know precisely what those strains are, but this is the sort of thing I would expect to see ahead of a fairly significant move up in gold. But that has to be justified. It has to be justified by the fundamentals. And here we come back to the situation over debt, over the stability of credit in terms of its value. Now, clearly, there are central banks around the world who look at the relationship between gold and currency and basically want to get rid of their currency reserves and replace it with gold. What are they doing? Are they buying gold? No, actually, what they're doing is they're getting out of currency. They're getting out of credit. This is the key point.
And that's Alasdair Macleod's take on the evolving role of gold and the BRICS nations' ambitious plans to challenge the global financial order. What do you think? Do the BRICS nations' master plan for a gold-linked system hold the potential to reshape the global economy, or are the obstacles too great? Let us know your thoughts in the comments below, and don't forget to like and subscribe for more daily recaps. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.